Recent findings by the African Private Equity and Venture Capital Association show that East Africa accounted for 18% of the total number of private equity deals in Africa. That's a value of $1.4 billion between 2010 and the first half of 2016. To discuss the appetite for private equity deals in East Africa, my guests are Ponmile Osibo, Manager for Research and Training at the African Private Equity and Venture Capital Association, and Christoph, Evard, Partner at Kibo Capital. Gentlemen, thank you so much for joining us today. And Ponmile, I want to start with you. Maybe you can just help us unpack the latest report by AFCA and what you're saying in terms of deal flow in East Africa.
So our latest finding for East Africa shows that there were 167 private equity deals done between 2010 and 2016, half one. That accounted for 1.4 billion. But what we're seeing is that there's a lot of interest in the consumer-related sectors, such as consumer staples, such as agribusiness and fast-moving consumer goods. We're also seeing interest in the financial services sector as well, especially in what we call diversified financial services. So this is looking at investments beyond banks in insurance and pension funds, pension fund providers, and also in consumer discretionary. In addition to that, we're seeing increasing interest from investors in healthcare, also in real estate. So there is a lot of activity that we're seeing in the East African market. It is relatively nascent and maturing. There are lots of new funds that have raised in the past 7 years that have invested and are now looking to exit their investments. So we've actually seen exits, the number of exits increase in East Africa. We've seen a total of 35 exits, and that number has increased in the past 3 years. So it's a very vibrant market with a lot of investor appetite, just from a private equity perspective, but also it's very attractive. Some investors coming out of the Middle East and Asia see it as a sort of a good foothold and landing space into the African market.
All right, and clearly Kenya is getting the bulk of those flows, at least so far. Over half of the deals and the value of deals are related to Kenya. And that tells us a lot about the history. But going forward, I'm interested to get your thoughts on where you think the deals are going. From the more recent past, what can we work out from where most deals are likely to going forward?
Kenya has been a large hub. We expect to continue to see that trend, but increasingly we're seeing investor interest in other countries there. Uganda, for one, Tanzania is another. Ethiopia has attracted a lot of investor interest as well, especially due to its large population and a lot of other drivers for growth in terms of power and large manufacturing base. So beyond Kenya, a lot of the other countries in the region are seeing private equity activity increase, albeit from a low base, but they are beginning to see an increase in private equity interest as well. And we expect to see this trend continuing in the next 3 to 5 years. But Kenya will continue to account for the largest share.
All right, Christoph, I want to bring you into the conversation right now. Maybe you can reflect on that last point as well. Where do you see deals going forward?
Maybe just before I do that, to piggyback on one point that Ponmile just raised, I think the numbers 2010 to 2016 have been very solid for East Africa. If you look at it in the order of the years and the development over these 5.5 years, it has been even more impressive. In 2010, 2011, you saw most of the deals in terms of volumes, in terms of numbers in Southern Africa. And not only with the onset of the commodity down cycle, but also with the continued robust growth in East Africa, you've actually seen a decrease of this differential up to the point that now in the first half of 2016, as many deals have been done in East Africa as in Southern Africa, which is a first and which we're quite proud of, I must say, as market participants in East Africa. Now, Kenya, as Ponmile already said, Kenya obviously will provide the bulk of the new investments going forward. Why is that? We believe that a big answer to that is in the types of deals that you're seeing. Look at the consumer business, at the manufacturing. If you look at the formal retail penetration, you look at the big supermarket chains here, you're approaching not South African levels, but certainly formal retail penetration way above what you see in some other parts of the market. And all of that is coming from Kenya. manufacturing as well. If you look at economies of scale, you look at the cost of importing a good and producing it, it's a very natural tendency for a Kenyan company to grow into Uganda and ultimately, into Rwanda and beyond. And it is very less so the other way around. You have very few manufacturing businesses, say out of Rwanda, who are big enough to actually compete with successfully with the Kenyan markets and the other, in the other East African place. So, I would fully subscribe to the notion that Kenya, also with its most sophisticated market structure, will remain the main point of entry for most investments.
But two markets really interest me today. There's Ethiopia, given the size of the population. Potentially there's a huge consumer market there. And of course, Rwanda, given all the progressive steps we've seen that government take in terms of attracting investment into that country. And I wonder to what extent those two factors could impact the flows going forward into those two countries.
I think if you look at Ethiopia first, it's always been we call it the mother of the African growth story, right? So you have double-digit growth, you have 100 million people, you have, coming from a very low base. There's tremendous opportunity there. Also, the policies that the government has set in terms of building a local manufacturing base and working a lot on local infrastructure, be it electricity, be it roads, be it whatever it is, provides for an extremely attractive macro story. Now, the trick with Ethiopia is obviously the execution, as it is everywhere, but in Ethiopia ever more so, because the regulation is not as sophisticated, arguably, as it is elsewhere. The government is quite involved in a lot of the parts of the economy. There is a capital control, effectively, with the US dollars. So when you come in as an investor, you have to take all of this into account. So I believe that we will see significant growth and investment into Ethiopia. I believe, we've all heard about the ongoing riots and demonstrations and the way the government is trying to deal with it. And I think it's a little bit too early to tell how successful the government reply is to these internal issues. And that might well prove to be a big stumbling block in the growth of Ethiopia going forward. But we as Kibo, we're looking actively at transactions there as well, and we remain quite optimistic. Now, Rwanda is slightly different in that it comes from a very different place, right? It's not near coast, it's relatively small. You have a very efficient administration, you have great rules. You also have a certain political involvement in the day-to-day business and in the economy overall. So doing business there, the reality is also that it is sometimes more difficult than it seems. The main disadvantage that Rwanda has is that it's so small that its domestic market is quite small. So from a manufacturing perspective, again, it is very difficult to build companies of scale that go beyond the borders and compete successfully. So you're really looking at services from our point of view, financial services, healthcare, education. I would say those are the main plays that we see in Rwanda.
All right, Ponmile, I want to come back to you and to hear your thoughts about the impact of regional integration, because if you look across the continent, East Africa perhaps is the best example of a region that has been integrated economically to a large extent. And I'm wondering, to what extent does that impact the flow of capital? For instance, a country like Rwanda, given the progressive steps we're seeing in terms of driving investment flows into that country, I imagine that could be a hub for many businesses that are looking to explore opportunities across the region. Are we seeing that impact in private equity flows?
The integration, as you said, gives the opportunity for businesses to effectively scale across the East African region through the East African community. But also there is some leverage. There is some leverage through COMESA as well for that integration to happen at another scale. But what we're seeing is private equity firms are looking to take advantage of this. So they're coming into companies, not always in Kenya, but maybe in other East African regions that have the right fundamentals and are looking to scale effectively. An example of that is Catalyst Principal Partners recently invested a couple of years ago in Chibora in Tanzania. and they're now using that. They've now expanded from Tanzania to selling their products also in Kenya, and are looking to grow their footprint in Kenya as well. So that's been helped by this increase in regional integration. And it's also, when we speak to some of the fund managers operating in that region, it is something they always effectively look at, because part of private equity in Africa is about growth, about value creation. And for them to be able to achieve that, they need to be able to scale these companies typically from one country to across a region as a whole.
Before I go into a break, Christoph, I want to come back to you and hear your thoughts about the early stage investing opportunities. And so we're talking things like venture capital. And at the end of the day, I think the progress that we see in that space really will provide the pipeline of potential investment opportunities longer term. And when you look across the region, where are we seeing the best example of development of small businesses that potentially could attract private equity over the longer term?
Certainly. I think, again, this honor has to go to Kenya. It has quite a few incubators in the technology space specifically. It has a government policy that is geared quite heavily towards supporting these types of business. And as importantly, it has a lot of venture capital and angel investment available. And so I think being in Kenya is probably a big advantage on that. It's important to note that the type of investment and the type of company you're building is obviously very important for this, right? If you build something, let's say a greenfield agriculture sort of startup, you're looking at cash flow cycles and investment cycles that probably go beyond the life of an ordinary standard private equity fund. While if you go into the IT space, where scale really is dependent not on seasons, not on the weather, but really on your product and your ability to push it in the market, this can go much quicker. But again, there is a big differential between the venture capital world on the one hand and the private equity world on the other, as you see it here in Kenya and East Africa. And I think there are not yet that many businesses that had managed to make that move and make that shift from venture capital to private equity. There are a few success stories, and they're wonderful. And a lot of them, in fact, have also been funded and supported by development finance institutions, by foundations and the like. So again, I would say Kenya is the most attractive market here.
I'll take a break now. I've been speaking to Ponmile Osibo, manager for research and training at the African Private Equity and Venture Capital Association, and Christoph, Evard, partner at Kibo Capital. As we continue our discussion on private equity deals in East Africa, my guests are Ponmile Osibo, manager for research and training at the African Private Equity and Venture Capital Association, and Christoph, Evard, partner at Kibo Capital. And Ponmile, I want to come back to you and just reviewing where we're seeing the most transactions. So consumer staples, financials, consumer discretionary, and real estate make up 64% of the volumes of deals over the reviewed period 2010 to 2016. But if you can break that down a little more for us, because I do get the sense that technology, given what is going on, especially in Kenya, could be an area that we could see significant deal flow into. So your thoughts on if you can break it down further for us, where are we seeing the most deals, and going forward, what's your sense of where we will see more deals?
So, you are right. There is we are seeing increase in investment in the technology-enabled businesses, whether this be in the financial services in terms of fintech or agribusiness-enabled technology applications helping farmers in the East African region, and also in medical insurance or medical tech. So we are seeing increased investment in there, but as Christoph had mentioned earlier, that it is building on the ecosystem that is being developed in Kenya at the moment. So we're seeing a lot of activity there, but some of these businesses are still fairly early in their life cycle. They're still at proof of concept stage. So private equity and venture capital, although have backed some of these companies, they're still at a low base at the moment. I would say in the next 3 to 5 years, they will start becoming much more of a major component of the deal flow that we're seeing. It is there. There's a lot of interest, but it still needs to develop, and some of these companies need to become proven entities, and then we will continue, as the story builds, we will start seeing increasing deal flow into those regions. But as you had mentioned, healthcare is one of those that we're just seeing a lot of growth into that particular sector across the region at the moment.
Christoph, do you want to reflect on this point as well? I just do get the sense that tech could be big, but clearly consumer-focused businesses will also be big going forward.
Look, I think tech is already very big. And if I look at the portfolio companies, the partners that we're working with throughout our different funds, every single one of them has technology on its agenda. It's been discussed in the boardrooms, been discussed on management level. We're actively revising implementation strategies. So I would think that technology is already having a big impact, and I think it not necessarily will always be the one startup that goes through the incubator and that's going to change the world in East Africa. But very often it's also technology transfer. You know, we have a logistics business in Kenya that we're growing regionally with a strategic partner that's making heavy use of technology in order to increase and improve the customer experience and therefore make the business more transparent, more flexible, more efficient, ultimately more profitable for everybody. The same with healthcare. We have a big healthcare investment. We work with a large global player on that. There's a lot of transfer coming there. We have in-house staff that's looking at IT solutions, and some of these solutions actually we buy locally. Some we don't. So I would think that technology is already playing a big part. It will continue to do so and increase in importance. And yes, some of these solutions will certainly be sourced locally, and you will see that in the Africa statistics hopefully over the next couple of years.
I just get the sense that East Africa, especially Kenya, is just well groomed for technology businesses. But moving away from that, I want us to reflect on what authorities can do to drive further flows. Now, clearly, the government needs to provide the enabling environment, the economic environment for businesses to thrive. You mentioned capital controls, perhaps being a reason why we haven't seen more flows into Ethiopia. So we get all that. But beyond that, I'm just thinking that what more can the governments and the authorities do to develop small businesses that would attract more private equity capital into these countries in terms of grooming small businesses and so forth? Can you just reflect on that?
Certainly. So look, I think if you look at Rwanda, and you mentioned Rwanda as an example, the time it takes to set up a new business in Rwanda, it's fantastic. You know, it's better than most developed countries, really. And I think a lot of the other markets in East Africa can look at Rwanda and are looking at Rwanda and are trying to implement similar structures in order to make it easier for the entrepreneur to start something, you know, and tax breaks for young companies and other sorts of incentives. I mean, you have the Silicon Savannah that's quite well pushed by the government and senior people in the Kenyan government. So I think this is one part of the equation. The other part, as you mentioned, is an enabling society also for the private equity funds. And again here, you know, we've been investing in this market for just about 10 years. And the developments and the improvements we've seen in most countries in East Africa is significant. And you know, for us private equity investors, what we need is transparency. We like double taxation agreements. We like very clear tax structures, and you know, the less room there is for playing games and the less room there is for uncertainty, the better it is. And you know, you're a foreign investor looking at Africa, and one of the key issues, the perceived risks that you're seeing, is the government, quite frankly. So if, as a government in East Africa, you manage to convince these outside investors by saying, hey, look, these are our policies, this is what you're getting, you know, no other costs, this is all very transparent, I think you will see tremendous success.
Ponmile, I want us to reflect on exits. And in your report, you've noted 35 exits between 2010 and the first half of 2016. It doesn't sound like a lot, but that could reflect the stage of development of the industry. Going forward, what do you anticipate in terms of exits? And do you think what role would the local capital markets play in this? Are we likely to see some companies getting listed? How do you see that playing out?
Just looking, before I talk about that, I just wanted to build on something else on the point you had Christoph mentioned earlier. I think one thing that governments are doing in the East African region, and I'll use Kenya as an example, is really looking to unlock local capital from pension funds and that will act as sort of a catalyst to attract more capital and help grow the private equity industry, which will further be able to invest in the local economies. So regulations that are being changed to be more supportive of that, and we're seeing increasing interest from local pension funds who want to in Kenya who want to invest in private equity funds. So I think that's a positive, and that's something that shouldn't be overlooked as what the government and the regulators are looking to do in the region. Now, pivoting to your point about the exit environment in East Africa as a whole, yes, 35 looks like a relatively small number compared to some of the other regions, but it's really just showing the development of the private equity industry. As Christoph said, his company has been investing for 10 years in the region. So that's roughly about the full cycle of a private equity fund. They have some exits under their belt, and we're seeing other funds in the region begin to exit portfolio companies. That number is due to go up, and we will continue to see some of these exits come out. What sectors would they be in? It would particularly be consumer discretionary. We've said I was in Kenya just recently speaking to a lot of managers. They have a lot of exits they have exits they want to achieve over the next 6 to 12 months. And there will be in some of the sectors we've discussed. But in terms of exit routes, the predominant exit route at the moment continues to be sales to trade buyers. So these are multinationals coming in and looking for assets to buy. We are also seeing exits to some private equity firms. The listings on the stock exchanges, very low across Africa. It's not just particular to East Africa, but we know that there are discussions are ongoing to look to help facilitate some of those where possible. But it's really about regulation and policy that will increase the likelihood of seeing more listings in the East Africa region.
Christoph, you live in the region. Would you say exiting private equity is perhaps more difficult in East Africa? Is the environment more challenging to make that happen? What are your thoughts on this?
Well, I think first of all, it's very hard to overestimate the importance of exits for the PE industry as a whole. Why is that? It is because it complements and it completes the whole investment cycle, right? And it really shows the fruits of the execution and how well one can execute on the macro story that is Africa. If you put yourself in the shoes of large international investors, pension funds and fund of funds and others, it's all about cycles. And it's not only about actually the exit itself, it's about having teams, GPs, private equity managers, completing a cycle from cradle to grave, so to speak. And therefore seeing those increasing quite a bit is a significant development for us here in East Africa. Now, we have exited in the last year, we've exited one deal we're successfully, and we're doing two more right away. And we're seeing that it is not much more difficult or less difficult than in other markets. Of course, you have a market like South Africa that's a bit more liquid, where you have more capital available, so by and large you have more exit opportunities. But if you just look at Sub-Sahara Africa, outside of South Africa, no, I would say it is all about two things. It's about your ability to structure an exit, which usually starts already when you do the investment. So how aligned are you with the other investors to get a majority exit to sell the whole company? And how can you position the asset in the market that it becomes interesting for potential buyers? Now we have seen a significant increase in private equity funds on the ground here. So you will also have seen an increase in secondary sales to other private equity funds, but also strategic sales to international companies, global companies, as well as South-South Corporation, Indian companies, Mauritian companies, South Africans that come to East Africa. Right. So I would say it rather depends on the asset and on the structure than really on the market.
All right, let's leave it there. Many thanks for that conversation. I've been speaking to Ponmile Osibo, Manager for Research and Training at the African Private Equity and Venture Capital Association, and Christoph Evard, Partner at Kibo Capital.